Welcome everyone. Today on the Joseph Carlson Show, I want to talk about what I consider to be the best investment ever. In fact, I truly believe this to be the ultimate investment. It's not an individual stock. And I know that I talk a lot about individual stocks. I talk about companies that I think may be the best companies in the world, ones like Apple or Microsoft, Salesforce, Intuit, MasterCard, and Visa. I talk about all of these companies and I invest in these companies. I've made decent gains buying individual companies, but I don't consider any of these individual companies to be the ultimate investment or the best investment ever. I believe the best investment ever is the ETF, the exchange traded fund. And I don't think most people fully appreciate how good of an investment an ETF is. In fact, I believe that if more people actually knew how good ETFs are and how they really function as investments, I think more people would be stuffing their money into ETFs. Every chance they get, I think they'd be buying ETFs because of how good of investments these are. The first thing I think is important to mention is my background. I am mostly a stock picker. The majority of my money is in individual stocks. And like I've shown repeatedly on my channels, I make large investments into individual companies. I invest in them based on the principles of Warren Buffett, buying a company and earning returns through its cash flows and its earnings growth. So I'll buy companies, ones like Costco, and earn returns because Costco is gaining members, gaining earnings, they're growing their free cash flow, and you get returns that way. Now, I've done this on two different portfolios. I have the passive income portfolio, and then I have my other portfolio called the Story Fund, which is more of a growth-centered portfolio. But this one has also done phenomenally well. It's been a really well-performing portfolio because of the concentration into very high-quality companies that are generating a lot of cash, a lot of returns for investors. So my background, for the most part, is investing in individual companies, making bets on them. And that's something that's never going to change. I'm always going to be investing in individual companies. I love doing research. I love making big bets on companies, big investments, and sharing in the reward when these companies have a very financially prosperous future. Between these two accounts, the passive income portfolio and the Story Fund, I have nearly $1 million invested into individual stocks. All of that money into a handful of companies, and that represents how strongly I feel about these companies. But I also have a few other smaller accounts. I have a retirement account, a Roth IRA, I have a little 401k. Then I also have some kids' custodial accounts for my children. So I have a couple accounts. They're not nearly as big as these ones, but in those accounts, I don't pick individual stocks. In those accounts, I'm investing in ETFs, and in one ETF in particular. And I think this is a good way to go about things. I think most people can benefit from having some, or in some cases, the majority of their money in ETFs. You can make bets on individual stocks and do that as a portion of your portfolio, but I think ETFs are a nice place, a really good investment to have at least some, if not the majority of your money in ETFs. And I want to explain why. Most people don't fully understand or appreciate the mechanics of ETFs and what makes them so good. They are advantageous in almost every way you can consider an investment. For example, if we compare an ETF to buying real estate, a simple comparison, many people consider real estate the best investment of all time. I don't think so. I think an ETF beats it. The reason why is because when you buy a piece of real estate, when you buy a rental property, there's a couple things you have to do. First of all, you have to come up with capital. You need a down payment. That requires a lump sum payment. So you're saving up a large amount of money, in some cases $30,000, $40,000 to get in the door, to be able to buy that property. Then when you buy it, you have a concentrated risk in a single location. When you buy real estate, you only have one location. You have to monitor that location. You have to get it rented. That takes active work. So now you've taken on a bit of a side job. You have work that you have to do on the side, and in some cases that can be quite a bit of work. I know I've had real estate in my family growing up. So you have an active job, you have a lump sum payment. You also usually need a loan, so you're taking on some leverage, which brings on additional risk. And then you're not diversified. You only have one property that you need to monitor throughout the life of that property. If anything happens to it, if the tenants break an appliance, if anything happens, you're on the hook for that. You have to monitor that property, keep it rented, or you have to sell it. So it is an active investment in every way possible. Real estate can generate great returns, but there's so much more involved with it, and there's so much more risk involved with it. You can compare that to an exchange-traded fund. An exchange-traded fund is a vehicle that follows an index fund. So we have different companies like S&P Global that create an index, which is a routine method of following stocks. And then an exchange-traded fund is a different method of following that index. So when you're invested in an exchange-traded fund, you're basically investing in the index through a proxy. It sounds complicated, but it's actually pretty simple. There's many different companies that offer ETFs. You have Schwab, you have Vanguard, you have Fidelity, all these different companies making ETFs, and they all typically follow very popular indexes. Now, there's numerous advantages to following an index. One of them is that unlike real estate, you don't need a large upfront lump sum payment to get into it. You can start buying ETFs typically at like $50 or $60 per share. So every paycheck, whether or not it's $500, $400, you can start buying shares of an ETF. So the bar of entry is much lower than real estate. You can add in small amounts of incremental capital every single month, and you can continually add to it. Whereas if you buy a piece of real estate, you can't keep adding to that property. You'd have to buy an entirely new property. With an ETF, you can buy additional shares every single week, every single month. The incremental additional capital to it makes it an easy investment to dollar cost average into. The other thing is that ETFs automatically diversify your money. Again, if you buy an individual piece of real estate, you got one property, you have all the specific risks of that property. If you buy an individual stock, you have one investment there, one company with specific risks. When you buy an ETF, it automatically diversifies that money into hundreds of companies. So with an ETF, you already have the advantages of ample liquidity. You can buy and sell at any time. You have a low bar to entry, allowing you to add incremental capital fractionally anytime you get additional money. And you have instant diversification. These are all massive advantages in any type of investment. But you also have another advantage, and I think that this one is probably the most misunderstood advantage, or at least the one that I don't think is talked about the most, and that is the fact that ETFs are self-cleansing. They are self-healing. It's what they call rebalancing. Every 6 months, most indexes go through a process called rebalancing, where they look at their methodology for picking stocks. They do analysis on all the holdings they have, and they remove any holding that no longer fits into that methodology, that no longer fits in their framework. They replace it with one that does fit in that framework. This is rebalancing. It's a reconstitution of the entire index. They look through it and they remove stocks and they add in new ones. The new ones better represent what the methodology fits. And they do this behind the scenes, passively. The index automatically rebalances every 6 months, so the ETFs automatically rebalance every 6 months. They remove out all the bad stocks and they bring in new good stocks. This means that no matter what, no matter how long you go, you always have the best stocks in your portfolio. You always have ones that at least are represented in the methodology of the ETF. And you do this without any work at all. So again, if we go back to investing in real estate or owning a property, you just have that one property. If you want to make changes, you have to make changes. You have to go and sell that property and buy a new one. You have to run into problems with liquidity, with going through a whole sales process, with picking out a new investment. With an ETF, it's completely passive. You literally don't do anything. They rebalance your entire portfolio without you doing a thing. You don't even know about it. And if you have a good ETF with a good methodology, this results in you always having the best investments in your portfolio at a given time. A way that I look at it is it's almost like an investment that has an immune system, where if you run into any bacteria or infection or disease, your immune system will fight it off. It will self-cleanse the problem. In this case, if you have some companies that perform really poorly in an ETF or an index, if they have fraud, if they have really poor decisions, if they're doing poorly as a company, the index rebalances, pushes those bad companies out of the index, replaces them with good ones. This is the self-cleansing nature of an ETF, ensuring that your investments always stay on track without you doing any active management whatsoever. So to summarize, when you look at the benefits of an ETF, it's pretty remarkable. And this is why I consider it the best investment of all time, the ultimate investment. I can't think of any other investment that has this many good qualities, that's this passive, that's this hassle-free. It has incredible liquidity, low bars of entry, instant diversification. It's self-cleansing, self-rebalancing, and continues on forever and ever. It is the ultimate investment. And on top of that, ETFs are incredibly difficult to beat in total returns. Some of the major indexes are so difficult to beat that most investors cannot beat them. through real estate or through stocks. They are tough to beat. So you have a very good investment here, but it is dependent somewhat on the specific ETFs you pick, because not all indexes are created equal and not all ETFs are created equal. So what I want to do is go through examples of 2 ETFs that I think are the very best, and then also go through a couple ETFs that I would personally avoid. And number 1, we have an ETF that I consider to be the best in the world. And this is the one that I have all of my secondary accounts in, my retirement accounts, my kids' custodial accounts. And if I wasn't investing in my portfolio, if I was to sell all of my stocks and put it into an ETF, 100% of it would go into this ETF. That's how much I like it. It is Schwab's US Large Cap Growth ETF. The ticker symbol is SCHG. This is a Schwab ETF, but Schwab is not the one that makes the index. Again, ETFs are vehicles to invest in that follow an index. The index is the Dow Jones US Large Cap Growth Total Stock Market Index. This is an index created by the Dow Jones, which is a company, S&P Global. If we look at this index from Dow Jones and see how it's constructed and the methodology and the performance, we can see that this thing has had incredibly good performance. Over the past 10 years, it's returned 16.68% annualized. It's a very good annualized return. But obviously, looking at historical performance is always tricky. What if it performed well historically, but it's not going to do well in the future? Well, the way that I determine whether or not something's going to do well in the future is the methodology, looking at how they construct their fund and how they pick companies and how they weight these companies. When we look at this one, we can see from the name of it, there's a couple implications. It's US large cap and growth. So we know that it's going to be US only stocks. They're going to be larger stocks and probably $10 billion market cap. And it's a growth ETF, not a value ETF. Now, this is still very vague. What does all of this mean? Well, luckily for us, they go through and highlight specifically how they pick their stocks and how they weight them. For example, this right here is from the Dow Jones, and it explains the intricacies, the details of how they separate growth from value. So you have these vague terms, value and growth, which can mean a lot of different things. This is actually how they define it. This is how they separate it. A stock's style classification, growth or value, is determined by the company's performance in terms of 6 measures: 2 projected, 2 current, 2 historical. Projected price to earnings ratio, based on the stock's closing price at the time of the annual review and its mean annual expected EPS over the next fiscal year. So one of the ways they determine whether or not the stock is a value stock or growth is the projected price to earnings ratio. They continue on saying the projected earnings growth. So they factor in the rate at which the company is growing earnings, the price to book value, the dividend yield, the trailing revenue growth, and the trailing earnings growth. So they look at all these factors, and then based on that, they separate stocks into 2 different baskets, one of them being growth, one of them being value. Now, once they're done separating growth from value in this very mathematical and methodical way, they move on to index construction. And this gets more nuanced and more mathematical. They basically go through a process of removing all outliers. They do this by a mathematical formula. They normalize a lot of metrics, and then they weight the companies based on these different factors. The ones that are growing the fastest, the ones that have the biggest market cap, are weighted the largest. And then, as you'd suspect, the ones that are growing the slowest and have the smallest market cap are weighted lower down. So you have the weighting and the construction of this portfolio. Now, if we look at how this actually works out, you have a portfolio that is heavily weighted towards the top performing large cap growth companies. The company that this index and SCHG considers the best investment, Microsoft. Microsoft is 12% of the portfolio. Then you have Apple at 11%. You have Nvidia at 11.5%. Amazon at 6.5%. And then you have the 2 Google tickers, the 2 Alphabet tickers at around 7%. You have Meta at 4%. You have Broadcom at 2.7%. You can see how top heavy this is. Now, top heavy in this situation, I don't think is a bad thing. I really like ETFs that continue to invest in the biggest winners and continue to hold those companies. I believe the reason why these ETFs continue to do so well is they continue to hold the winners and weight them bigger and bigger. Following the winners typically works out to be a good thing. I believe the reason that small cap ETFs, small cap indexes, and mid cap indexes aren't doing as well is the winners graduate out of their index and they move into the large cap. When you get into the large cap, there's nowhere for these companies to go. They never graduate out of this index. If Microsoft continues to double and double again, SCHG will continue to hold it as a top holding. It won't graduate and move on to a different index. So this is the reason that I favor large cap indexes. I like the fact that they hold on to the winners indefinitely, that companies don't graduate and move out of them. And not only that, I think that the global nature of business today, the fact that companies like Microsoft and Apple can do business literally anywhere, means that there's far more growth avenues than there were 50 years ago. So these companies are going to continue to grow for a long period of time. We move down the list. It has companies like Tesla, United Health Group, great compounder. We have Visa, Costco, MasterCard, and Netflix. Notice why I like this ETF so much? It has so many great companies in it. These are compounding machines. It rules out a lot of the slower growing companies. For example, it doesn't have Berkshire in it. It just is growing a little too slow. But you have companies like Adobe, Salesforce, Thermo Fisher Scientific, Intuit. These are a lot of the names that I hold. This is the reason that if I wasn't investing in my portfolio, this would be the ETF that I'd pick. Now, there's different companies that I disagree with. For example, I'm a little nervous about NVIDIA's valuation. I also am a little bit nervous about Tesla with their valuation and the reliance on full self-driving. So these are companies I wouldn't pick myself, but the purpose of an ETF is to detach yourself and have it be completely passive, to have no biases, to have it all be completely mathematical by a set criteria and then to set it and forget it. That's the magic of an ETF. Now, one thing I want to point out, a lot of people will say, Joseph, why do you pick SCHG over the QQQ or the NASDAQ 100? Isn't this basically the same thing as the QQQ? It's not. And I actually believe that this is superior to the QQQ for a few different reasons. The biggest reason why is because the QQQ can only invest in companies listed on the NASDAQ. So if you're investing in the QQQ, it has an artificial limit, a constraint on where it can feed its investments from. All of it comes from the NASDAQ 100. The QQQ can never invest in companies from the New York Stock Exchange, even if those companies from the New York Stock Exchange were just as good. Even if they were compounding machines and fast-growing companies and technology companies, they could not be added to the QQQ because the QQQ cannot select companies from the New York Stock Exchange. So you artificially and biasly get rid of a group of companies that are excellent companies. Two examples of this is MasterCard and Visa. If we look at two of the top holdings of SCHG, this selects Visa and MasterCard. These are two great technology growth companies with wide moats. They're duopolies, and they are excellent investments. These are two companies I love owning. SCHG has them in this ETF. Whereas if you look at the holdings list of Invesco's QQQ, you will not see Visa or MasterCard. I can search for it here. No Visa, no MasterCard. Doesn't exist. Those companies aren't in this index because Visa is listed on the New York Stock Exchange and MasterCard. Both of these are NYSE stocks. Therefore, the QQQ cannot add them to their index, even though these are incredibly good companies and better than many, if not most of the companies in the QQQ. They're better growth companies than many companies in the QQQ. Now, the QQQ is great. I think it's a great index. It has lots of top holdings of big tech. But I just like the fact that SCHG can add companies from both the New York Stock Exchange and the NASDAQ 100. It has a bigger area to select from, so it has a better, more full collection of companies that are excellent growth companies. So overall, SCHG is my top pick for investors wanting to invest in a group of compounding machines without doing the specific work of picking them out. It has incredibly good historical performance. It has a very low expense ratio of 0.04%. That's super cheap. It has ample liquidity. You'll have no problem buying and selling this ETF. And I think it will go on for a long period of time. I don't think just the historical performance is good. My opinion is that future performance will be good. Now, there's no guarantees. Nobody can guarantee future performance. But as long as the US economy does well and the top companies in the world seem to surface in the US, this ETF I think is going to do well. So I would be fine putting the majority, if not all of my money into this ETF. And if I wasn't investing in a lot of my individual picks, which are very similar, I would be picking the ETF. Now let's go ahead and move on to number 2. This one's for the dividend investors. This is what I consider to be the all-time best dividend ETF. It's SCHG. SCHG. So SCHG is for growth, SCHD is for dividend. Both of these ETFs are offered by Schwab, but the index that they follow is created by the Dow Jones, by S&P Global. And as you'd suspect, this is a US-based dividend equity ETF, meaning that they're not doing any covered call options. There's no funny business going on. This is just US companies that pay hefty dividends that are also growing their dividends over time. If we look at the way that this index is constructed, it's pretty simple, but it's a step-by-step process. First of all, the people constructing this index, they look at the entire universe of stocks within the US. So you have the Dow Jones US Broad Stock Market Index. That's another index that holds basically every stock in the US. And then they exclude REITs. So we don't want REITs in this index dominating all these dividend players. We want pure equity in non-REIT companies or normal companies. The stock must pass through the following screens. So first of all, they look if the companies have a minimum of 10 consecutive years of dividend payments. Right off the bat, they exclude a ton of companies. So you first start with every company, then you see if they have 10 years of dividend payments. Not dividend growth, just consecutive years of dividend payments. You have different liquidity requirements, like trading requirements, different market cap requirements. Then they start going through the mathematical formula for different parts of the company. They don't only want to see that the company has paid a dividend, but they also want to see other things, like if the company has a decent balance sheet, if the company can continue to pay dividends. They first start off by looking at the free cash flow to total debt. That's looking at the stability of the company, the balance sheet, the situation they're in. They look at the return on equity, a ratio showing how good the company is with profitability. You look at the dividend yield of the company. They look at the 5-year dividend growth rate defined as this big long formula, looking at the dividend growth rate over the past 5 years. The 4 ranks are summarized to create a composite score, and the eligible securities are ranked based on the composite score. Then they take the top 100 ranked stocks in this composite score and they include those in the index. That's how they make up the Dow Jones 100 Dividend Payer Index. Now, the top 100 stocks make up the index and they'll stay in this index as long as they don't fall below the top 200. So getting into this index originally is more difficult than getting kicked out of it. They have to be a top 100 to get in it. They have to be outside of the top 200 to get kicked out. Non-constituent stocks are added to the index based on their ranking until the constituent count reaches 100. This is where they rebalance and they have the reconstitution of the index. And at the end of this, you have a pretty good collection of dividend growing stocks. That's why the companies do well. That's why this index does well. And again, if they don't, if they have underperformance and they fall out of that top 200 constituents, then they get kicked out. They get rebalanced, kicked out, and replaced with new companies. Now, when we look at the portfolio, there's an important thing to mention here. This is an equal weighted portfolio. So they don't weight it by market cap. They just start every company around 4%. And then they'll go up a little bit if they perform well. They'll make a bit of a bigger portion of the index. If they perform poorly, they'll go down. Now, it rebalances every 6 months. So again, they'll sell off the winners. They'll buy more of the losers. That's something that I don't necessarily love. But overall, equal weighted indexes haven't done so bad historically. In this market, it's more top heavy. There's companies like Nvidia, Apple, Microsoft pulling up the market. But historically, equal weighted indexes have performed quite well. And this is a great equal weighted index that's dividend growing companies that's a bit more conservative. Overall, I think SCHD, this dividend growth index, is really good for investors that want to be more conservative. They don't want a lot of their money in big tech. They maybe have felt that big tech has pushed up too far. You're nervous about valuations. You want to conserve a bit more of your money. I think this is a good ETF for very cautious or conservative investors that want to focus more on capital preservation and conservative, more value-oriented bets than large growth plays and compounding machines like you find in SCHG. But again, I believe SCHG is the best dividend growth ETF in existence. So there's 2 ETFs that I think are the best in their category. They follow stable, predictable, and I think very intelligent methodology that has led to very good risk-adjusted returns. But there's also ETFs that I think are bad. They're gimmicky or they destroy wealth. In some cases, they're ones that are actively managed. You have ETFs managed by people like ARK Innovation. ARK Invest ETF is picking stocks haphazardly without any type of set methodology. It seems like they're just shooting at the hip. and their performance has shown it's been incredibly poor performance. On top of that, they charge incredibly high expense ratios. So the managers of these ETFs are getting rich while they're destroying investors' capital. These are bad ETFs. So don't believe just because something's an exchange-traded fund that it's a safe or good investment. You have to be discerning between the good ones and the bad ones. The good ones have stable, predictable, passively managed methodology. The bad ones are actively managed by people that take on great risk and don't have stable or predictable methodology. Another group of ETFs that I think is very popular online and one that I would caution against are covered call ETFs. These ones attract a lot of investors, especially dividend investors, because of the juicy yield. Everyone loves to look at yield. You just love looking at these big numbers, these big payouts. It lights up those endorphins. I understand it. I get it. But covered call ETFs, I think, deserve a word of caution. We have some popular ones here, like the NASDAQ 100 covered call ETF, QYLD. This one has such an incredible yield. We look at what this pays out every month, and it pays out 11%. That's the annual yield, but it pays that out every single month. So if you're investing in this ETF, you're getting like 1% back per month. That seems incredible. You're getting such a massive yield from this ETF. I understand the allure of a juicy yield paid out on a monthly basis. It's rewarding to see the money come in, but it's more important to understand what's going on behind the scenes. In most cases, covered call ETFs are destroying the NAV value of the fund to pay out the ETF, meaning that they cannot generate this type of yield. They're not generating this from earnings or from cash flow. They're generating it from contracts and from destroying the NAV value of the fund, which means you're basically sacrificing all the upside of your investments to get this money paid back to you. And in most cases, that actually destroys value. It does not generate value. And ETFs like this are never going to generate alpha. They'll never beat the S&P 500. You can mark my words. Try to find any ETF like this that outperforms the S&P 500 over a 10-year period. You're not going to be able to do it. The S&P 500 has crushed every single covered call ETF in existence since its inception. You can name off any of them, and unless you try to really nitpick a specific short time period, the S&P 500 is going to win because these do not generate alpha. And I don't see much of a situation where these are beneficial to the huge majority of investors. So when I see it as a very popular thing for investors to put a lot of their money in this, especially young investors, I cringe a little bit. It's hard for me to see so much money going into these instruments when it could be used in compounding machines, in companies that are growing earnings, pure equity, and not these ones that destroy value. To prove this point further, we can look at the total returns of QYLD and compare it against the S&P 500. Since inception, this is what the returns look like. And this is with the dividends reinvested. So this is with that juicy 11% yield reinvested back into the portfolio. Over this time period, the S&P 500, which is in teal here, has crushed QYLD. It hasn't even been close. It's over doubled the performance since this short period of time. And this is not unusual. I see this type of thing all the time with covered call ETFs. And worse yet, this underperformance by these covered call ETFs is closely matched by their higher expense ratio. The expense ratio for QYLD is 0.61%. Over 0.5% is a meaningful amount. So you have part of your money being eaten up every single year by the expense ratio, whereas you can buy the S&P 500, you can buy SCHG for again around 0.04%. So QYLD is orders of magnitude more expensive to invest in while giving you far inferior performance. I don't think these are good investments. I would avoid them. The best investments are ones that are methodical, predictable, and repeatable. Ones that aren't gimmicky. They're not managed by third-party managers getting rich off of charging you high expense ratios. They invest pure equity, pure ownership of companies in growing economies. There's no contracts, no options, no other different complex things associated with them. So the ETFs like SCHG, the ones like the S&P 500, the QQQ, that own a basket of the best companies in the world are continually probably going to do the best in the world. Now, nothing is guaranteed. There's always a chance things could be different, but this is what I've seen over the past 15 years of investing. So take that for whatever it's worth. That's my thoughts on the subject. See you in the next one.